Look, I'm going to be direct with you. Something is happening right now in the precious metals market that most people aren't paying attention to. And in exactly 48 hours, a lot of folks are going to wish they had been watching more closely. I'm talking about a convergence of events that happens maybe once or twice in a generation. The kind of setup that, when you look back at the charts years from now, you'll see that clear inflection point where everything changed. And right now, we're sitting at that exact moment. Let me paint the picture for you, because this isn't just about one thing. It's about 5 or 6 major forces all colliding at the exact same time. And when that happens in markets, you get explosive moves, the kind that catch everyone off guard except the people who are paying attention. First, let's talk about what's happening with the US dollar right now. The dollar index just broke a critical support level at 101.50 that it's been defending for the past 8 months. Now, most people don't understand what that means. But let me explain it in simple terms. When the dollar breaks major support like that, it's like a dam cracking. At first, it's just a small leak. But once that structural integrity is compromised, the whole thing can go very quickly. And here's what makes this particularly dangerous right now. The Federal Reserve is trapped. They've got inflation that's still running hot at 3.4%, well above their 2% target. But at the same time, they've got a banking system that's sitting on over $600 billion in unrealized losses. You remember what happened with Silicon Valley Bank and First Republic? That was just the beginning. Those losses are still there, sitting on bank balance sheets like ticking time bombs. So, the Fed can't raise rates to fight inflation without potentially triggering another banking crisis. But they also can't cut rates without letting inflation run even hotter. They're stuck. And when central banks are stuck, that's when gold and silver start to move. But here's where it gets really interesting. Over the past 72 hours, we've seen something unusual happening in the COMEX futures market. The open interest in gold futures has dropped by 47,000 contracts. That's $9.4 billion worth of paper gold that just disappeared from the market. Now, when you see open interest dropping like that while prices are holding steady, it tells you something very specific. It means the weak hands are getting shaken out. The speculators who were playing with leverage are being forced to close their positions. And who's on the other side of that trade? Physical buyers, central banks, institutions that want actual metal, not paper promises. Let me give you some numbers that should make your jaw drop. In the first 11 months of 2024, central banks bought 1,037 tons of gold. That's the second highest year on record. But here's the kicker. In just the past 6 weeks, we've seen another 183 tons of reported purchases. China added 62 tons. India bought 37 tons. Poland picked up 21 tons. Turkey added 18 tons. These aren't small players. These are sovereign nations with trillion-dollar economies. And they're buying gold like their lives depend on it. Why? Because they know something that most retail investors haven't figured out yet. The global monetary system is changing, and it's changing fast. You've probably heard about BRICS, right? Brazil, Russia, India, China, South Africa. Well, as of January 1st, 2025, BRICS isn't just 5 countries anymore. They just added Saudi Arabia, UAE, Egypt, Ethiopia, and Iran. That's 10 countries now, representing 45% of the world's population and 35% of global GDP. And they're all working on one thing: reducing their dependence on the US dollar. Now, I know what you're thinking. You've heard this story before. People have been predicting the death of the dollar for decades, and it hasn't happened. And you're right to be skeptical. But here's what's different this time. It's not just talk anymore. It's actually happening. Saudi Arabia just announced they're now accepting yuan for oil payments from China. That's huge. The petrodollar system, which has been the foundation of US dollar dominance since 1974, is starting to crack. When the Saudis start accepting other currencies for oil, that's not a theory, that's reality. And it's not just oil. Russia and China are settling trade in their own currencies. India is buying Russian oil in rupees. Brazil and China are trading in yuan and reals. The de-dollarization trend isn't coming. It's here. It's happening right now. So what does this have to do with the next 48 hours? Everything. Because on Thursday we've got the FOMC meeting minutes being released. And based on the recent comments from Fed officials, there's a very real possibility we're going to see language that suggests rate cuts are coming sooner than the market expects. If that happens, the dollar is going to drop hard. And when the dollar drops, gold and silver explode higher. But there's another factor that most people aren't talking about. The silver market is even more interesting than gold right now. Silver just broke above $30 an ounce for the first time since 2013, and it's holding that level. That's significant because silver has tried to break $30 7 times in the past decade and failed every single time. But this time feels different. Why? Because the fundamentals in silver are absolutely insane right now. Industrial demand for silver is at all-time highs. Solar panels alone are consuming over 200 million ounces per year. Electric vehicles use twice as much silver as traditional cars. 5G infrastructure, AI data centers, defense systems, they all need silver. And we're not mining enough to keep up with demand. Global silver mine production is around 830 million ounces per year. Total demand is over 1.2 billion ounces. That's a deficit of 370 million ounces. Every single year. Where's that extra silver coming from? Above ground stockpiles. And those stockpiles are getting depleted fast. The COMEX silver inventories have dropped from 410 million ounces in 2021 to just 267 million ounces today. That's a 35% decline in 3 years, and it's accelerating. In the past 6 months alone, we've seen 43 million ounces leave the COMEX vaults. That's 16% of total inventory gone in half a year. Now here's where it gets really wild. The silver market is tiny compared to other markets. The entire above-ground investment silver market is worth maybe $50 billion. That's nothing. Apple's cash reserves are bigger than the entire silver market. If just a small fraction of institutional money decides to move into silver, the price could go parabolic. And we're starting to see signs that's exactly what's happening. Silver ETF holdings have increased by 47 million ounces in the past 3 months. That's the fastest accumulation rate since 2020, when silver went from $12 to $30 in just 6 months. But here's what really keeps me up at night: the gold to silver ratio. Right now it's sitting at 89 to 1. That means it takes 89 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages around 60 to 1. And during precious metals bull markets, it often drops to 40 to 1 or even lower. If we just revert to the historical average of 60 to 1 and gold stays at $2,650, that puts silver at $44 an ounce. That's a 47% gain from current levels. But if we get a real bull market move and the ratio drops to 40 to 1, we're looking at $66 silver. That's a 120% gain. And here's the thing: silver moves fast. When it goes, it really goes. In 2020, silver went from $12 to $30 in 6 months. In 2011, it went from $18 to $49 in less than a year. When silver catches a bid, it doesn't mess around. Now, I want to talk about something that's relevant for a lot of people watching this. If you've got $100,000 or more sitting in retirement accounts, there's something you should know about. I put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical gold and silver into your retirement account without triggering tax penalties. It's worth checking out if you're thinking about protecting your retirement savings from what's coming. But anyway, let me get back to what's happening in the market right now, because there's another piece of this puzzle that's absolutely critical: the mining sector. Gold and silver mining stocks are still trading at historically cheap valuations. The GDX, which is the major gold miners ETF, is trading at a price-to-earnings ratio of just 14. That's cheap, really cheap, especially when you consider that gold is near all-time highs. Normally, when gold is at record prices, mining stocks are expensive, but not this time. Why? Because investors don't believe the gold price is sustainable. They think it's going to come back down. But what if they're wrong? What if gold isn't going back down? What if we're actually in the early stages of a major bull market that's going to take gold to $3,000, $3,500, maybe even $5,000 over the next few years? If that happens, mining stocks are going to absolutely explode. Because they have leverage to the gold price. If gold goes up 50%, mining stocks typically go up 150% or more. That's the nature of the business. Higher gold prices mean higher profit margins, and higher profit margins mean much higher stock prices. And we're starting to see the smart money position for this. In the past month, we've seen major institutional buying in names like Newmont, Barrick Gold, Agnico Eagle. These aren't retail investors buying a few shares. These are hedge funds and institutional investors taking multi-million-dollar positions. But let me bring this back to the 48-hour timeline, because that's what this is really about. In the next 2 days, we've got several catalysts that could trigger a major move in precious metals. Thursday's FOMC minutes are the big one, but we've also got jobless claims data, manufacturing PMI numbers, and consumer confidence reports all coming out. If any of these numbers come in weaker than expected, it's going to reinforce the narrative that the Fed needs to cut rates sooner rather than later, and that's rocket fuel for gold and silver. But even if the numbers come in strong, we've still got the technical setup that's extremely bullish. Gold is consolidating right below its all-time high of $2,685. It's been holding the $2,600 level like a floor for the past 3 weeks. That's not weakness, that's accumulation. Big players are using this consolidation to build positions before the next leg higher. And silver, like I mentioned, just broke above $30 and is holding. That's a major technical breakout. The next resistance level is $30.50, and if we clear that, there's not much standing in the way until $35. And once silver gets to $35, the psychology changes completely. Suddenly, everyone who's been sitting on the sidelines starts paying attention. FOMO kicks in. And that's when things get really interesting. Now, I want to talk about something that happened in 1980, because there are some eerie parallels to what's happening right now. In 1980, gold hit $850 an ounce, and silver hit $50. Those were astronomical prices at the time. Adjusted for inflation, that's $3,200 gold and $188 silver in today's dollars. What caused that spike? A combination of factors: high inflation, geopolitical instability, a weak dollar, and a loss of confidence in the financial system. Sound familiar? Because that's exactly what we're dealing with right now. But here's what's different. In 1980, interest rates were at 20%. Paul Volcker, the Fed chairman at the time, crushed inflation by raising rates to levels that would be unthinkable today. That's what killed the gold and silver bull market. But today, we can't do that. Our debt levels are too high. The government is paying over $1 trillion per year just in interest on the national debt. If rates went to 20%, that interest expense would go to $7 trillion per year. That's more than the entire federal budget, so we're stuck with low rates and high inflation. And that's the perfect environment for precious metals. It's why central banks are buying. It's why institutions are positioning. It's why the smart money is getting ready for what's coming. Let me give you another historical example. In 2008, during the financial crisis, gold dropped from $1,000 to $700 in just a few months. Everyone thought the gold bull market was over. But then, over the next 3 years, gold went from $700 to $900. It nearly tripled. Why? Because the Fed's response to the crisis was to print trillions of dollars. And all that money printing eventually showed up in gold prices. Well, guess what? We just went through the same thing. In 2020, the Fed printed $5 trillion in response to COVID. That's more than they printed in response to the 2008 crisis. And we're just now starting to see the effects of that money printing show up in asset prices. Gold has gone from $1,800 to $2,650 in the past year, but I don't think we're done. Not even close. Because here's the thing about inflation, it doesn't just go away. Once it's in the system, it's incredibly hard to get rid of. The Fed can talk about bringing inflation back down to 2%, but the reality is that they've never successfully done that without causing a recession. And they're trying to avoid a recession at all costs because of the election cycle and political pressures. So what's going to happen? They're going to let inflation run hot. They're going to claim it's transitory or under control, but the reality is that prices are going to keep going up. And when people realize that their dollars are losing purchasing power, they're going to look for alternatives. And the oldest, most reliable alternative to fiat currency is gold and silver. Now, let's talk about what's happening in China. Because this is crucial. China has been on a gold buying spree for the past 18 months. They've added over 400 tons to their official reserves. But here's what most people don't know. Those are just the official purchases that they report. The actual amount is likely much higher. China has a long-term strategic goal of reducing their dependence on the US dollar. They hold over $3 trillion in foreign exchange reserves, and a huge chunk of that is in US Treasury bonds. They want to diversify out of dollars and into hard assets, and gold is at the top of that list. But it's not just the Chinese government. Chinese citizens are buying gold and silver at record rates. In 2024, Chinese gold demand was over 1,200 tons. That's more than any other country in the world. And it's accelerating. Why? Because the Chinese real estate market is collapsing. Property values are down 30–40% in major cities. The stock market is struggling. Where are Chinese citizens putting their money? Gold. And this creates a fascinating dynamic. As Chinese demand increases, it puts upward pressure on global gold prices. But higher gold prices make it even more attractive for other buyers to jump in, creating a self-reinforcing cycle. This is how bull markets work. They feed on themselves. Let me tell you about what's happening with the LBMA, the London Bullion Market Association. This is where most of the world's gold trading happens. In November 2024, the LBMA reported that their gold vaults held 9,847 tons of gold. That sounds like a lot, but it's actually down from 10,234 tons in January. That's 387 tons that left the vaults in just 10 months. Where did it go? To buyers who wanted physical delivery. And this is important because the LBMA is the backbone of the global gold market. When gold starts leaving LBMA vaults at an accelerating rate, it means the physical market is getting tight. And when the physical market gets tight, prices go up. It's basic supply and demand. The same thing is happening in silver. The LBMA silver vaults held 1.04 billion ounces in January 2024. By November, that number was down to 967 million ounces. That's 73 million ounces gone in 10 months. And remember, global silver demand is running at a 370 million ounce annual deficit. Those vaults are going to keep draining. Now, here's where the 48-hour timeline becomes critical. If we get dovish language from the Fed on Thursday, if they hint at rate cuts coming sooner than expected, we could see a massive rush into precious metals, not just from retail investors, but from institutions, hedge funds, and algorithmic trading systems that are programmed to buy gold when certain conditions are met. And once that buying starts, it can snowball quickly. We saw this in March 2024, when gold went from $2,150 to $2,450 in just 3 weeks. That was a $300 move in less than a month, and it caught everyone off guard. The analysts who were calling for gold to go back to $2,000 suddenly had to revise their forecasts. But here's what I think is going to happen over the next 48 hours. I think we're going to see gold test the $2,700 level. If it breaks through that, the next stop is $2,800. And once we're at $2,800, the psychology changes. Suddenly, $3,000 gold doesn't seem crazy anymore. It seems inevitable. Silver is going to be even more explosive. If silver breaks $32, I think we could see $35 within days. And if we get to $35, we're looking at $40 very quickly. Because silver has been coiled up for so long, when it finally breaks out, the move is going to be violent. And here's the thing that most people don't understand. When precious metals start moving, they don't move in a straight line. They move in waves. We'll get a big surge, then a pullback, then another surge that takes out the previous high. This is how bull markets work. They shake out the weak hands on every pullback, and then they reward the people who hold on through the volatility. I've been watching precious metals markets for over 15 years, and I can tell you that the setup we have right now is one of the best I've ever seen. We've got weak dollar, dovish Fed, geopolitical instability, de-dollarization, supply deficits, strong physical demand, and technical breakouts all happening at the same time. When you get that kind of convergence, big moves happen. But here's my warning to you. If you're going to get involved in this market, you need to be prepared for volatility. Gold and silver can move 5% in a day. Mining stocks can move 10% or more. This isn't a market for the faint of heart. But if you can handle the volatility, the potential rewards are enormous. And one more thing, don't wait for the perfect entry point. Don't wait for a pullback that might never come. If you believe in the thesis, if you understand what's happening in the global monetary system, then you need to position yourself now. Because once this thing really gets going, you're not going to get a chance to buy at these levels again. The next 48 hours are critical. Watch the Fed minutes on Thursday. Watch how gold and silver react. Watch the dollar. Because what happens in the next 2 days could set the tone for the next 6 months. And if I'm right about where this is headed, 6 months from now, we're going to be looking at gold prices and silver prices that seem unbelievable from today's perspective. This is your alert. This is your warning. The precious metals market is about to make a major move, and you've got 48 hours to decide if you want to be positioned for it or if you want to watch it happen from the sidelines. The choice is yours. But don't say you weren't warned.